One Monday morning, one of the most powerful banks on earth simply vanished. $600 billion in assets, 25,000 employees, 158 years of history. Gone. Not in an explosion, not in a scandal broadcast live on television, but in a quiet filing signed inside a Manhattan office building. No robbery, no hackers, no natural disaster, just paperwork signed by the very people who built the bank in the first place. By the closing bell, the stock market had lost more value than on any single day since the September 11th attacks. Within a year, millions of American families would lose their homes, their jobs, or their life savings because of decisions made behind closed doors, months before anyone outside those walls understood what was coming. And here's the part almost nobody remembers. After the biggest bankruptcy in American history, after a collapse that touched nearly every family in this country, almost no one went to prison for it. Somebody built this collapse, and almost everybody walked away. To understand how a company survives 2 world wars, the Great Depression, and over 150 years of American history, only to disappear in a single weekend, you have to understand what Lehman Brothers actually was. It didn't start on Wall Street. In 1850, 3 immigrant brothers opened a small dry goods store in Montgomery, Alabama. From cotton trading, it grew, decade after decade, into one of the most powerful investment banks in the world, a firm that helped finance railroads, airlines, and some of the biggest names in American business. By 2007, Lehman Brothers was the 4th largest investment bank in the United States. Roughly 25,000 employees, billions of dollars moving through its doors every single day. To most Americans, it was invisible, just a name on a building they'd never walk into. But that name was quietly tied to something that would eventually touch nearly every household in the country: the market for mortgage-backed securities. Here's the simple version. Banks were handing out home loans to millions of Americans. Firms like Lehman bundled thousands of those loans together into a single investment product, then sold pieces of it to investors around the world. It sounded almost foolproof. Real estate always goes up, or so everyone believed. There was just one problem, and it was already sitting inside the deal. In the early 2010s, something started to shift. Lending standards across the country began to loosen, not gradually, but fast. Banks and mortgage companies started approving loans for people who, 10 years earlier, would never have qualified. These became known as subprime mortgages, loans handed to borrowers with weak credit, sometimes with almost no verification of income at all. For a while, none of it seemed to matter. Home prices kept climbing. If a borrower couldn't pay, the house could simply be sold for a profit. The system appeared to fix itself. Lehman Brothers didn't just participate in this market, it went all in. The firm bought several subprime mortgage lenders outright, giving it control over the entire pipeline. From the loan officer approving a mortgage in a suburban neighborhood to the trading desk repackaging that same loan and selling it to investors in London and Tokyo. By 2007, Lehman had become one of the top underwriters of mortgage-backed securities on Wall Street. And to squeeze out even bigger profits, the firm did something that in hindsight looks almost reckless. It borrowed enormous sums of money to make its bets even larger. At the peak of this strategy, Lehman's leverage ratio, the amount of debt compared to its own capital, passed 30 to 1. Picture that in human terms. For every single dollar Lehman actually owned, it had borrowed more than $30 to place additional bets. That's the financial equivalent of buying a house with barely any money down, except this house was worth hundreds of billions of dollars, and it belonged to one of the most trusted names on Wall Street. As long as home prices kept climbing, this made Lehman enormous amounts of money. But somewhere out there, quietly, prices had already started to turn. By 2007, cracks were spreading. Homeowners across the country, especially those with adjustable-rate subprime mortgages, began missing payments. As interest rates reset higher, monthly bills that once felt manageable suddenly jumped by hundreds of dollars. Multiply that by millions of households, and a slow wave of defaults began rippling through the entire economy. For Lehman, this wasn't just bad news, it was existential. The mortgage-backed securities it had bet so heavily on were now losing value fast. And because the firm was so leveraged, even a small decline in asset value could wipe out a massive share of its actual capital. But here's where the story stops being about bad investments and becomes something else entirely. Internal records later revealed that Lehman had been using an accounting maneuver, now known as Repo 105, to temporarily move billions of dollars of debt off its balance sheet, right before the company had to report its finances to the public. In plain English, right before the world was allowed to see how much debt Lehman was actually carrying, that debt would quietly disappear from the books. Once the reporting period ended, it would just as quietly come back. This wasn't a rumor or a conspiracy theory whispered on trading floors. It was documented in Lehman's own internal communications, later uncovered by court-appointed bankruptcy examiner Anton Valukas, which means the investors, employees, and regulators who thought they understood how healthy this company was weren't looking at the real picture. They were looking at a version of it. By the summer of 2008, Lehman was sitting on tens of billions of dollars in troubled real estate assets it couldn't sell. Rival banks began pulling back. Lending partners grew nervous. And on Wall Street, confidence isn't just a mood, it's the fuel that keeps an entire institution breathing. Once that fuel runs out, the countdown starts. Here's the part of this story that changes everything you think you understand about it. This wasn't one bad bet by one reckless trader. It wasn't a single rogue decision made in a single room. It was a system, leverage stacked on leverage, numbers hidden right before the world was allowed to look, incentives that rewarded risk-taking today and left the consequences for tomorrow. By September 2008, that system had run out of road. Lehman Brothers spent its final days searching desperately for a buyer or a bailout, anything that could keep the doors open. Barclays and Bank of America both explored acquiring the firm. Talks with Barclays collapsed at the last possible moment, reportedly over concerns from British regulators. Bank of America turned instead to Merrill Lynch, another firm in trouble, leaving Lehman without a rescue partner and without time. Unlike Bear Stearns months earlier, and unlike AIG just one day later, the federal government made a different choice this time. It let Lehman fall. On September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy, with more than $600 billion in assets, the largest bankruptcy filing in American history, a record that still stands today. The shockwaves were immediate and global. Stock markets around the world plunged. Credit markets froze almost overnight as banks became too afraid to lend to one another. The very next day, the government reversed course and issued an $85 billion emergency loan to insurance giant AIG, terrified of what a second collapse in 48 hours could unleash. Weeks later, Congress passed the Troubled Asset Relief Program, a $700 billion effort to stop the bleeding across the entire financial system. But by then, the damage had already reached Main Street. Over the following 2 years, the country lost more than 8 million jobs. Nearly 4 million American families faced foreclosure. Retirement accounts tied to the stock market lost trillions of dollars in value almost overnight. The people who lost the least were, in many cases, the ones standing closest to the decisions that caused it all. And here's the part of this story that most people never learn. After the largest financial collapse since the Great Depression, after trillions of dollars vanished, millions of jobs disappeared, and a housing crisis displaced families across the entire country, almost no senior Wall Street executive was ever criminally charged. Lehman's CEO, Richard Fuld, testified before Congress. He faced brutal public criticism and became one of the most recognizable faces of the crisis. But he was never criminally charged. No senior Lehman executive was. Across the wider financial industry, the same pattern repeated. Regulators pursued civil penalties. Some firms paid billions of dollars in fines. But criminal convictions of top executives tied directly to the causes of the crisis were almost non-existent. Why? Because in American law, recklessness isn't the same as a crime. Proving that executives knowingly and deliberately committed fraud, rather than simply made reckless, aggressive, poorly judged decisions, is an extraordinarily high legal bar. Much of what happened at Lehman was arguably irresponsible. Very little of it was ever proven in a courtroom to be criminal. This is the mechanism almost nobody sees. The financial system doesn't just run on money, it runs on rules. And in 2008, those rules made catastrophic risk-taking survivable for the people at the very top, even while it devastated everyone underneath them. Lehman Brothers no longer exists. Its name is gone from the buildings on 7th Avenue. But the real story didn't end in 2008. The system that allowed a firm to borrow $30 for every dollar it actually owned, to make its own debt disappear right before investors could see it, and to collapse without a single senior executive facing criminal consequences, that system was reformed. It was not rebuilt from scratch. New regulations followed. Banks today hold more capital and face more oversight than they did in 2007. But the deeper question the Lehman collapse raised has never really gone away. When a financial institution grows large enough, complex enough, and interconnected enough, Who is actually responsible when it fails? For the 25,000 employees who lost their jobs that week, and for the millions of American families who lost their homes in the years that followed, the answer felt obvious. But in the eyes of the law, it turned out to be almost nobody. That's the uncomfortable truth underneath this entire story. The largest bankruptcy in American history wasn't caused by one villain, one decision, one bad day. It was the product of a system built on leverage, hidden numbers, and misaligned incentives, where the people who took the biggest risks were rarely the ones who paid for them when everything fell apart. So the next time a headline tells you a bank is too big to fail, it's worth remembering what actually happened the one time we let it. If you want more documentaries breaking down the financial forces shaping everyday American life, subscribe. This is only the beginning of these stories.